to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth Podcast. I am your host, Prof, and today we have a special guest, Matt Wallace, joining me live. And so this is great. Matt, how are you?
Excellent. Thank you for having me.
Absolutely. So Matt, why don't you start off by telling us a little bit about yourself and how you got into real estate?
Sure. I was a Penn State grad back in 2006. I was in the business school, always economics minor, always very interested in just economics and supply and demand, all of that. And so I first started out my career in finance at the Chicago Board of Trade, where I was an options trader. And really, the biggest skills I learned there were just kind of complex financial modeling. And after a 7-year run there, as all of our volume started to go to the computers and the algorithmic trading firms, that's when I got into real estate. I really liked, instead of the split-second trading decisions, really taking the time to analyze markets and buildings, and, demographics, and what really works best for communities and things like that. So like a much bigger bets, frankly, but much more thoughtful and more analysis as opposed to just being the fastest on the floor. So that's what really turned my eye to real estate. And my first opportunity that I had was with a major REIT, real estate investment trust out of Cleveland, named DDR. They focused on shopping centers, almost entirely. They're large format retail. And I jumped into their transactions team just after the financial crisis. So the company was going through some turmoil, and that's where I got to cut my teeth. So it was a great entryway into real estate where I got to take on a lot of responsibility with the handling of the transactions.
That's awesome.
Beginning of.
So you're now in the Cleveland market.
Correct. And
you work as a broker.
Correct.
So what kind of things are you seeing specifically? We'll start with like maybe Ohio as a whole and maybe shifts overall in the retail sector.
So retail has been certainly one of the most tumultuous asset classes of the last 15 years. And I jumped in really when it was at the bottom, right? So the company I referenced I was with, they had almost gone bankrupt, multiple bankruptcies across large big box retailers, had impacted their cash flow significantly to where their stock was at a peak of $80 around 2006. And when I joined, it was $4. And that was after it bounced off of 82 cents. It was the actual low. So very close to actual bankruptcy. So we were able to retool the portfolio, stabilize it, and move forward into this new era of retail. So when I jumped in, it was very much in this retail apocalypse era. People thought retail and bricks and mortar were going away, right? Amazon was going to take over the world, and everything you can get on the internet, and all you need is just sit in front of your computer all day. It turns out consumers don't actually like it. Now, there's certainly been a shift in lots of different business models, and we've seen a ton of bankruptcies because of Amazon, the Amazon effect. But what's happened over time is smart retailers have adjusted, like any business, creative destruction. The smart retailers have adjusted. So that began first with omnichannel strategies, and then also just a refocusing on what those retailers' core business function is. Like one that shifted really well and did into that omnichannel space was Best Buy. Best Buy was on the brink of bankruptcy not long ago, and they were one of those companies that did a massive turnaround and really found their footing. So not only did they focus on omnichannel price matching, so it's like, hey, if you find the price on Amazon, come in, we'll match that. Boom. So it takes away that incentive. But then they also added in a reinvestment in customer service they also didn't invent this concept, but the store-in-store. We've seen it in malls and department stores. They've done it as well, where they partnered with AT&T, they partnered with Samsung, they partnered with a lot of these other tech firms to lease space in their stores and directly sell their products with an expert there. And that focus on customer service really brought people back to the store, and you get people in the store and sales. That was one strategy. Another strategy that worked, you'll look at value-focused retailers like TJ Maxx, Ross Dress for Less, Burlington Coat. They don't have omnichannel strategies. They're not heavily invested in internet and their distribution channel, direct to consumer at all. Their whole business model is you're going to get your goods cheaper here, and it's going to be a treasure hunt. It's it's what you can find when you go. So you have to come to the store, you have to look through the goods, and you're going to get a great value for something that you will like, So that was really that, refocusing on the core, what they actually like, their values as a company was value retail. So, they would just buy all the inventory from department stores that was and mark it down. And that's it. But they stayed true to that and end up delivering that great experience to the customer. So that treasure hunt has always been such a satisfying event for the consumer.
Yeah. So. I mean, I enjoy a good treasure hunt.
It's fun. And I went with my kids for school shopping.
Yeah.
It's like
you go in, you don't even know what you need, and you come out with
a
whole bunch of stuff you didn't know you needed. Now, I needed this.
I was not expecting to spend $300
exactly.
at TJ Maxx the other day. I went in for 2 pairs of shoes and I left with 3 bags.
Absolutely, so right. It's fun.
So refocusing on the consumer and how to really cater to those needs is what's important. And some weren't able to do it. Like you look at Bed Bath & Beyond, and when I started in retail and was really focusing, Bed Bath & Beyond was the example of strong, excellent, well-run retail. Their balance sheet was incredibly, we called it a fortress balance sheet. You wanted them on your site plan because you knew they were paying money. Right. And over time, they just never adjusted their business plan, never adjusted their model. Their stores became dated. And frankly, the inventory, what they sell is easily replicated online. Like if I need cheap towels for my dorm room, I just order it online. I don't need to go see and feel these towels and this kind of goods. Let's call it the made for TV kind of stuff in the store. Yeah. And that it's very easy to just put that online on Amazon and just compete on price.
Right. Exactly.
So they were never really able to adjust that. And when they had the opportunity to salvage themselves, because their Bye Baby business line was very successful and it held up the rest of the company for a long time, but they refused to divest and ended up taking down the whole thing. Now, the brands themselves, Bye Baby, will probably have a resurgence here, but at the end of the day, they just refused to change with the shifting consumer mindset, and ultimately that's why they're gone.
Yeah. So. I always thought that it would be interesting if Toys R Us and Bye Bye Baby merged together to kind of incorporate both values that, I know we're both parents. And so if I had a place that I could go where my kid could play, I could be shopping too. And I mean, I remember going to Toys R Us as a kid it was so much fun.
It was great.
I couldn't wait to go to Toys R Us.
The problem, Toys R Us did have Babies R Us.
That's right.
So they did have, and that they almost, Bed Bath & Beyond saw what happened to Toys R Us and still failed to execute
change anything.
Because Toys R Us had Babies, which was doing well, although Bye Bye Baby was better than Babies R Us. But regardless, Toys R Us had this, it was the same model, because the toys that you would go in and pay a markup for and have your kids play with and I need this now, I have to have this. It's very easy just to do that online. There's no real value to the consumer coming in. You don't need to talk to an associate. You don't need to try something on. Now I can tell you personally, I'm very unhappy with shopping online for toys. I feel like at this point the quality has gone down so far, and like anything, the pendulum swings in one direction and it's now swinging fully back in the other direction. I frequent our local toy stores very much more often because, again, I know what I'm getting.
Right.
If I go clothes shopping, if it's at a TJ Maxx, like, yeah, I feel it. I had it. I can try it on. If it's at like a higher end store, if I'm going for a suit or something, like I need to try that. I can't buy that online. So like, there's these avenues of retail that are still thriving. In the bricks and mortar space. And then there's these, these areas that can operate in this omni-channel, and then there's stuff that's just always going to be online. I don't ever need to go buy like toilet paper or anywhere. I can just
absolutely.
Just strategies have shifted and markets overreacted early on, and now they're swinging back. And where we sit today, retail fundamentals are the healthiest that they've ever been since in the last 20 years, right? Since 2004, 2006, when malls still down. Occupancy is up, bankruptcies are down, and rents are going back up. So we're in that area where now we're looking to develop. Over for 15 years, we were over retail. We had too much square footage dedicated to retail in this country. A ton of that has been reconverted. Malls, B minus C malls, are being converted into distribution centers or like mixed use office parks. The B stuff can be made mixed use, maybe with some, if it's in better real estate, with multifamily additions or some type of conversions. And the A malls are still healthy and strong. Like the stuff that the big guys own, Simon, Mesa Rich, still healthy and very productive malls. So funny enough, like what we saw happen to malls over the last 15 years as we've been this slow grind of reconverting square footage is what we're going to see in office in the next 15 years. It's just going to be this large, like this massive fundamental shift in how we utilize that real estate. And it's going to take 10 to 15 years to work through all of it as values eventually come down for investors to put money back into it to make it its highest investments.
So let's say I'm an investor and I come to you, Matt, and I say, Matt, I want a triple net tenant, which means I want a tenant who's going to pay all of my expenses. I don't have to worry about the taxes, insurance, the maintenance, the upkeep, anything. And I want to target a retail strip mall. And who are the target tenants that you're kind of seeing as like those anchor tenants that are really going to be stabilized? If I'm looking at assets that maybe already have tenants in place, where do you think is the best investment?
Such a wildly complicated
I know, right?
So
I threw a lot at you there.
Well, it depends. It totally depends on your risk preference and what you're looking for in yield, right? So if, we work with all ranges of investors. If you are primarily concerned with safety, coupon clipper, passive mailbox money, then, you want a 3-4 tenant strip, or just a single tenant net lease building. It's like, depend. If you're purely focused on just that mailbox money component of real estate, then just go buy a Starbucks at a 5.75 cap or some growth in rent or something like that. But in the unanchored strip space, which is an incredibly popular space right now, you're going to want, all your big credit national brands that you can guarantee are going to pay their rent, right? So that's your Starbucks, your Chipotle's, your Jersey Mike's. Mix in. You always want to have a good merchandising mix. So some service base, some medical base is always very hot right now, and very sticky tenancy. They don't leave very often because medical tenants have to invest heavily into their own space, so it creates a reason for them to stay when they're putting a ton of money into the space. So those like med spas, massages, Massage Envy, any of those national brands are really what you're going to target. Now, if you're what kind of yield you're going to get is obviously heavily dependent on your market and how much work you want to put in.
Sure.
If you're looking for a little bit more lift, you're going to go to tertiary markets, maybe have some vacancy, or maybe you can maybe you buy a fully occupied strip, but it has a lower credit profile. Maybe it's a mom and pop restaurant, and that's where like you can really find the value, right? So, a mom and pop restaurant, in a well-located strip that has been there for 50 years and is a community staple, I don't see a lot of risk in that, but is an investor that is, looking in Pennsylvania from the West Coast isn't going to understand how important that restaurant is to the community and how strong that credit actually is. So you as a savvy investor can probably pick up some yield by understanding that dynamic in the market. That's what the really fun part of real estate is, like really uncovering every rock and seeing like, oh, like where's this risk mispriced?
Right.
And that's also just like financing option. It's like
Yeah.
where is the risk being mispriced and how can I benefit? So again, like a million different ways you can approach that question, highly dependent on what your goals and motivations are as an investor, and ultimately your risk profile.
Yeah, no, I mean, that makes total sense. Now, I'm curious as to what your thoughts are for a town that's kind of transient. So here in State College, we have a transient town where our student population dies out over Christmas break. We die out over the summer, and a very similar concept to, destinations, especially seasonal destinations. And so how do you fill those types of spaces to ensure that they're going to continue being strong businesses when there is going to be a dip throughout the year?
Well, I'll tell you the asset class that I love for those markets are the short-term rental, right? Those types of markets work really well in that space. Now, when you're talking about traditional retail, I think one thing you can do with that is just creative structure of businesses, right? And depending on the sophistication of the tenancy. So if you're talking with a mom and pop business, or maybe like a mom and pop restaurant or a boutique shop, I'd be more inclined to, as an investor, and this is me personally, share in the upside and protect that business on the downside so that I stay occupied. And you can do that by having either low rent in general across the board, and then percentage rent during those peak times, or just percentage rent all the time, but that you'll benefit from in the peak times. So once they hit a certain sales threshold, the landlord starts to share in that. Or you can have, I've seen in the truly like vacation spot markets, like you'll see this in Myrtle Beach or any of the Carolinas areas where like they again have this like 3 months of huge windows of sales and then nothing. They literally will only pay rent but the rent is 4 times market, so that it eventually it evens out over time. So from a cash flow perspective, you can work with the tenants to do it like that, or they may prefer just to negotiate rent, handle that cash flow themselves. So, but having a very realistic understanding of their business and how they make money and their margins and things like that, like the closer relationship you have with the tenants, the better you can structure a deal that works for both parties. Like I feel like sometimes landlords and tenants are put too much at odds when really they need to think more like partners.
Yeah.
And that works better for them.
Absolutely. You want to keep your vacancy low. You got to keep your tenants in business. So you have to do what you can to support that.
Yep, absolutely.
So if I'm an investor and I'm looking at retail as an asset class that I'm hoping to get into, what is your best advice to maybe a newer investor or somebody who's maybe been investing in single family and wants to make the transition over to commercial?
Start small. I would say, retail is a different beast. And I would, before I'm going into more advanced strategies, value add, development, having to put out massive TI for a specific type of tenant. I just play it safe, get a few under your belt, right? Moderate leverage, leave a little bit of meat on the bone. So if you make a mistake, doesn't tank the whole deal, right? So, single tenant is always great. I think mistakes that new investors make often is focusing on the yield and not the fundamentals of the real estate. Like I'd much rather buy, irreplaceable dirt at a 5 cap than some tertiary play at a 9. Especially if I don't have a specific game plan and know exactly what I'm doing, I've done it before. So just getting over your skis in terms of the risk that you're taking is earliest mistakes and most often mistake that I see. Because we are unanchored strip retail is a very hot asset class right now. So my former company, DDR, where I worked, has now officially gotten out of the shopping center game and has the anchored shopping center game and has transitioned now to this new entity, Curbline. Curbline is strip retail right in the curb, hence the name. So it focuses on convenience, access, multiple trips per week, those daily drivers, and the benefit of that space is that rents are reset more frequently, so it keeps up with inflation better than the large format shopping centers with 10 and 15-year leases. And they're not as expensive to re-tenant. You don't have to put out, $50 a foot TIs on a 80,000 square foot space to get your huge tenant. It's there's the universe of tenants in the 1,500 to 5,000 square foot range is much larger. So not only do you have the ability for tenants to compete on rent, but it keeps costs down.
Right.
And that is a huge driver in your overall return.
Yeah, no, absolutely. Now, I know that we've seen a couple different trends of people wanting to get into, let's say, like car washes or laundromats or, other businesses like that. Where do you see those types of businesses fitting in?
Car wash has been a huge boom over the last 3 or 4 years or so.
Yeah.
Driven primarily just by the tax that they afford. You get rapid depreciation on. It started out as 100% depreciation year one, so you could buy these things that have almost no tax liability going in. Now that's changing. It's decreasing each year at this point by 20%.
I think we're at 60% this year.
Yeah, I think you're right. So that was always a big incentive. They're also relatively cheap to operate and to build. Once you put in the capital investment, they kind of run on autopilot. You don't have a huge employee count that you have to manage. So they're relatively simple businesses to run, and often all cash, which has certain benefits.
Or subscription models.
Exactly. It's an excellent point, because that just anytime you can have consistency and forecastable revenue just creates a ton of value, right? You don't have to worry about we're in a recession and people are not washing their car, because that's a luxury expense. So you've already locked them up for a year.
Right.
So subscription models, as much as I hate them, as interjected into every corner of our world.
And then you forget to cancel them.
No, exactly.
And you don't use them, and so then they're just collecting your money.
another asset class that benefits from that incredibly is self-storage.
Yeah.
People they'll rent these units and put their stuff in it, and then they forget they've had it for 3 years, and I can just throw all this stuff away. I just spend $3,000 storing the stuff that I didn't need.
Right.
And that was a huge benefit. That was a huge driver out of COVID, is that we saw an increase in migration all over the country, and we saw a huge demand for self-storage. It's another relatively cheap asset to construct that has low overhead, and once you get it up and running, it goes on autopilot as a business. So
right.
They're all, and again, the beauty of real estate, each of these little asset classes has these certain quirks and perks that are attractive to investors, and that's why understanding what the motivations and goals of any individual is what's most important, how they view their real estate decisions.
Yeah. So I'm curious, I'm going to ask you a personal question. What are you currently investing in?
Honestly, I dump all my extra cash into the stock market.
Okay.
And it's, for the most part, I do heavily invest in some of the real estate investment trusts that I know personally and that are very well managed. But my day-to-day, it's like the barber's kids having bad haircuts, or the the butcher, serving these kids the intros, because I'm almost like so exhausted by how much I'm in real estate and doing it for everyone else. And I'm just like, I just want something totally like, I don't want to even think about it. So I just dump all my cash.
Yeah.
Into that. So I have invested in multifamily prior, like smaller format multifamily, duplexes, quads, things like that. And they're good, but I don't want anyone to ever think that real estate investing is completely passive. It's a lot of work. So when when I'm doing it all day, every day for 10, 12 hours, the last thing I want to do is come home and have to
continue doing
it. Get it for myself. So, so that's my, I guess my dirty little secret. I'm actually not invested currently in direct real estate investments.
Got it. Well, and I think that's, an important point to make is that if you are going to get into real estate, it's not a get rich quick scheme. It's not something that, you're not going to fail at, most of the time. There's things that are going to happen. I mean, I had to evict one of my tenants and, that meant paying the mortgage for 3 months and upkeep and getting them out and now having to either relist it or sell it. So I think that we don't talk enough about the horror parts, but also, we often just like to highlight the upside, but obviously we have to consider the downsides too.
It's work. It is not, like you can try to create as much of a passive investment as you want. And there are obviously avenues that are more passive than others, but they come with much lower yield, or you're paying someone to manage it. You still have to manage the managers and things like that. So, it is work, and you can make good money in real estate. But I'd say it's better as a wealth preservation, vehicle than anything.
Yeah.
Because making money in real estate is a full-time job. So you can make money in lots of different full-time jobs. But as a wealth preservation tool, there's no better option.
Oh, absolutely. Absolutely. Yeah. And I really believe that if we can help educate people on how to invest smart and how to, understand the complexities of real estate and how they can take advantage of that to hopefully preserve that wealth and pass it down to the next generation. That's kind of been my mission.
Absolutely. And it's learning those little tips and tricks. I mean, from the continually deferring of taxes until you get to that step up in basis is the ultimate loophole. Like when we talk about like the 1031 gets all the headlines, but the step up in basis is the real loophole. Absolutely. Right. So the 1031 is just a mechanism to get to that point over time to increase your overall wealth over time until you get to that step up in basis, because that is where all of
the lucrative part.
Exactly. Yeah. The preservation component actually kicks into play.
Exactly. Yeah. So if somebody wanted to learn more about retail or reach out to you, what's the best way to contact you?
Email, certainly. Follow me on LinkedIn. We put out a ton of great content through Matthews. But also I do tons of extracurriculars, trying to get the message out, because like yourself, I love talking about this and I love educating people about it. So I'll go to campuses all around Cleveland and Midwest, just talk to students about career paths and ways to get involved in real estate and ways to think about it on a little different level than your normal investment and why it's different. But you can go on our website at matthews.com and look me up. I'm right there on an executive page and find my email. I respond usually within 24 to 48 hours, depending on what part of the season we're in.
Yeah, absolutely.
But I'm always happy to answer questions and meet new people that are interested in the space.
Love that. I mean, I know you've hired a couple of my past students.
Yeah,
so
Dante and was Byron?
Yeah,
Byron. He's still doing manufactured housing. He was my mentee when I was last year when I was participating in that program. So yeah, we got a lot of good kids from Penn State. Yeah,
love it. Well, Matt, thank you so much. Appreciate you being on the podcast.
It's a blast. Thank you.
Awesome. So that's a wrap for this episode of the Inspire Wealth podcast. I'm Prof out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.